Welcome to Market Movers. I'm Jim Urio with Scott Martin.
Hi, Jim.
So on Friday, we have the non-farm payroll number, which historically is the biggest data point of the month. Is it big enough this month to eclipse takeaway headlines from the economic impact of the virus or a changing political landscape?
This one may be a two-sided coin, Jim, because of the fact that this is not a number that I believe the market, if it wants to, say impacts or say factors in the impact from the coronavirus and all the frenzy that we've seen in the last couple weeks. However, the other side of that coin too is these numbers need to be positively momentous in the sense of looking at GDP, consumer spending numbers. If we are coming into a downturn, the better these numbers are before we go into that downturn, the better I think it is for the S&P 5.
The Fed moved 50 points on Tuesday. If we get a bad number, are they going to be quick to move again?
I believe they are, and I think that's what they should be doing, Jim. And given the fact that we have a meeting in just a matter of a couple of weeks, I think some terrible, or let's say lackluster, economic data points does push the Fed more towards maybe another cut.
Okay, we're going to talk about how the NFP number has implications on equity markets. I'd like to remind anyone the CME Group has minis, micros, and options on the NASDAQ, the S&P, the Dow, and the Russell. Today we're taking a pretty broad view of the stock market, because we're going to be looking at the S&P. Our goal here is to provide different ways to hedge your risk or express a directional opinion across specific time frames or in accordance with different risk tolerance. Today, Scott's going to be taking the bear case, and he's going to be using week 2 Wednesday options, and I'm going to be taking the bull case using the March micros. These are examples, not recommendations.
Yeah, Jim, why the week 2s, I guess, right? I'll tell you why. Because of the fact that I believe we've seen this before, where markets tend to digest non-farm payroll numbers over the course of a matter of days. It's not like the move is done by, say, Monday morning. So I believe looking at week 2s, like Wednesdays, for example, are ways to maybe express yourself. And in my case, looking at this bearishly going into this number and certainly the days beyond it. So as an example today, Jim, looking at buying the week 2 Wednesday, 29.75, 29.50 ES put spread for 5 ticks. This trade expires on March 11th. Risk $250, make potential $1,000. Underlying currently is 30.86. Now, why did I pick these levels? If you look at the top end of that put spread, those are the lows from Monday and Tuesday of this week. So I believe just for some bearish protection, of course, but also the fact that if the market starts to trend down there, I believe that's a level that the market's going to really look at heavily as we approach, say, maybe those lows from Monday and Tuesday. And therefore, if it fills out, it's going to fill out quickly, and that's why I picked those levels.
So what you're saying, so most of the people watching the show, most people in general, have a long position in stocks. You look at this as more of a hedge through a binary event or a speculative downplay?
Both, in the sense of I think I believe it's pretty fair pricing for the bearish protection you get through the number in a couple days after as well.
I'm taking the bull case here. 30.80 is a spot, in my opinion, to buy the micro. It was kind of on the short-term charts. It's kind of a level of support right now with a target of 31.80 on the upside. So a full 100 ticks. Again, this is a volatile market, so things are happening now. And a stop placed at 30.20. It risks 300 to make a potential 500. Did I widen it out long enough for the volatility or no?
Maybe on the upside you did. The downside's a little still too tight for me. I mean, 60 points away still feels a little tight for me. I mean, that can happen in a matter of minutes, as we've seen. So but it's the micros. So that's the great thing, as we talked about with the micros and the fact that the cost of capital is lower and that they're active. And so you can therefore, I believe, just manage those levels, maybe as even in the case of my put spread, where you just got to manage these levels a little bit more with the volatility so high.
Short answer, is this volatile period nearing its end?
No.
Interesting. Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.